Right now in the United States, there's a group of investors who can sell a massive amount of stock and legally pay $0 in federal capital gains tax. This isn't speculation. It isn't a theory, and it isn't something coming someday. It's already in the law. In 2025, a quiet change in the tax code created one of the most powerful and most overlooked tax opportunities in years. And it overwhelmingly benefits one group: Americans aged 65 and older. Here's what makes this dangerous. Most retirees think they understand capital gains taxes. They glance at a tax table, see a threshold, and assume that's the limit. That assumption is costing people tens of thousands of dollars. Not because they broke the rules, but because they never learned how the rules actually work. In this video, I'll break down the hidden mechanics behind this new opportunity, why timing is critical, and why this window won't stay open forever. If you care about keeping more of your money, not the government's, subscribe now, and let's get into it. To understand why this opportunity suddenly exists, we need to look at what actually changed in the tax code, and why most people never noticed it. In 2025, Congress passed a large tax package known as the One Big Beautiful Bill Act. Public attention focused on the political debates surrounding the bill. But from a financial perspective, the most important changes were far less visible. Buried inside the law was a quiet expansion of tax benefits aimed at older Americans, particularly those who are retired or nearing retirement. The law did not eliminate capital gains taxes, and it did not create a brand new 0% bracket. That 0% long-term capital gains rate has existed for years. What changed is how much room people now have inside that bracket, especially if they are age 65 or older. This matters because capital gains taxes in the United States are not based on how much stock you sell. They are based on something far more specific: taxable income. Taxable income is not your gross income. It is the number that remains after deductions are applied. And under the 2025 law, seniors are allowed to take larger deductions than before, on top of the standard deductions that already existed. For someone still working full-time, this change may not feel dramatic. Their income is fixed, predictable, and largely outside their control. But retirement changes the entire equation. Retirees often decide when to sell assets, when to take distributions, and when to claim Social Security. That flexibility turns deductions into a powerful planning tool. By expanding deductions for seniors, the new law effectively allows much larger capital gains to be realized, while taxable income remains low on paper. This is why the opportunity exists. The IRS does not tax the transaction itself. It taxes the final taxable income number after deductions. Once you understand that, the strategy becomes much clearer. In the next section, we will walk through a simple example that shows how this works in real life, and why so many retirees are accidentally paying taxes they never needed to pay. Stay with me. This is where it starts to click. This is where most people go wrong, and it's surprisingly simple. When people think about capital gains taxes, they usually picture a table with income thresholds and tax rates. They look at the number at the top of the 0% bracket and assume that's the maximum amount of gains they can realize without paying tax. Once they hit that number, they stop. That assumption feels logical, and it's completely wrong. The mistake is confusing capital gains with taxable income. Capital gains are what you earn from selling an asset. Taxable income is what the IRS actually uses to calculate your tax rate. Those two numbers are not the same, and the gap between them is where the opportunity lives. Taxable income is calculated after deductions are applied. That means the government first takes your income, then subtracts the standard deduction and any additional deductions you qualify for. Only what remains is used to determine which tax bracket you fall into. Here's why that matters so much in retirement. Imagine someone who is no longer working and has no wages, no pension, and no Social Security yet. Their only income for the year comes from selling investments they've held for a long time. On paper, that might look like a large capital gain. But once deductions are applied, the taxable income number can be dramatically lower. This is where many retirees accidentally leave money on the table. They stop selling assets too early because they are watching the wrong number. They are focused on the size of the sale, not the size of their taxable income. The IRS does not care how much stock you sold. It only cares where your taxable income lands after deductions. That single distinction changes everything. It means you can realize far more capital gains than most people expect, while still remaining inside the 0% tax bracket. Once you see this, the tax table stops being a limit and starts becoming a planning tool. In the next section, we'll walk through a clear, step-by-step example to show exactly how this plays out in a real retirement scenario, and how much tax-free income is often hiding in plain sight. Let's make this concrete with a simple, realistic example. Imagine a retiree named Bob. Bob stopped working at the end of last year. In 2025, he has no salary, no pension, and he hasn't started Social Security yet. His plan is straightforward. He's going to live off the stock he accumulated over decades. Bob knows there's a 0% long-term capital gains tax bracket. So he looks up the threshold for a single filer. He sees the number and decides to stay safely below it. To be conservative, he sells just enough stock to realize about $48,000 in capital gains, assuming that anything more would push him into paying tax. On the surface, that seems responsible. But here's what actually happens on Bob's tax return. That capital gain shows up as income, but it is not the number that determines his tax rate. Once Bob takes the standard deduction, his taxable income drops sharply. After deductions, the number the IRS actually uses to calculate his tax is far lower than $48,000. This means Bob stopped far too early. He could have sold significantly more stock, realized thousands of additional dollars in capital gains, and still stayed inside the 0% bracket. Instead, by focusing on the wrong number, he unintentionally left tax-free money untouched. This is not an edge case. This is extremely common. Retirees often anchor on the capital gains threshold itself and ignore the role deductions play in reducing taxable income. They think the tax table represents a hard ceiling, when in reality, it's more like a finish line that moves depending on your deductions. Once you understand this, the math flips. The question is no longer, how much can I sell before hitting the limit? The real question becomes, how much income can I realize before my taxable income reaches the limit? That shift in thinking is what separates reactive taxpayers from strategic planners. In the next section, we'll take this exact logic and layer in the new benefit for seniors, which expands this opportunity even further and explains why 2025 through 2028 may be one of the most attractive tax planning windows retirees have seen in years. Now, this is where the 2025 law truly changes the picture for retirees. Up to this point, everything we've discussed applies to anyone who understands how taxable income works. But the new tax law added an extra layer specifically for Americans aged 65 and older, and that layer dramatically expands how much income can be realized tax-free. Under the new rules, seniors receive an additional deduction on top of the standard deduction. This is often referred to as the senior bonus deduction. It may sound modest at first, but in practice, it has a powerful effect on the math. Remember, capital gains tax rates are determined only after deductions are applied. So every extra dollar of deduction creates more room before taxable income reaches the top of the 0% bracket. For someone under 65, deductions already create a meaningful gap between capital gains and taxable income. For someone 65 or older, that gap becomes much wider. This means a retiree can sell more assets, realize more long-term capital gains, and still appear to the IRS as having relatively low taxable income. Nothing aggressive is happening here. No loopholes. No special structures. Just deductions working exactly as the law intends. What makes this especially important is timing. Many retirees experience a gap period. They've stopped working, but they haven't started Social Security yet. Required minimum distributions haven't begun. Income is low and highly controllable. This is the exact environment where expanded deductions matter most. The senior bonus deduction turns those low-income years into a strategic window. It allows retirees to reposition their portfolios, reduce concentrated stock positions, or simply fund living expenses, all while minimizing or completely eliminating federal capital gains taxes. Once wages, Social Security, or required distributions enter the picture, this flexibility shrinks. The window doesn't disappear, but it becomes narrower and harder to use. This is why the combination of retirement timing and the new senior deduction is so powerful. It doesn't just save tax in 1 year, it can reshape how retirement income is managed over several years. In the next section, we'll look at the actual numbers this creates and why, for some households, the amount of capital gains that can be realized tax-free is far higher than most people would ever expect. Once you combine everything we've discussed, the implications become much clearer when you look at the actual numbers. For a single retiree under 65, understanding deductions already allows significantly more capital gains to be realized tax-free than most people expect. But once you cross age 65, the math shifts again. With the standard deduction and the additional senior bonus deduction working together, a single filer aged 65 or older can often realize roughly $70,000 or more in long-term capital gains and still remain inside the 0% federal tax bracket. assuming capital gains are their primary source of income. For married couples filing jointly, the numbers become even more striking. When both spouses qualify for senior deductions, the combined effect can allow close to $150,000 in long-term capital gains to be realized without triggering federal capital gains tax. For many households, that is not a small tactical move. That is a strategic repositioning of wealth. This is where retirement planning stops being about withdrawals and starts being about timing. Imagine a couple entering retirement with a large, concentrated stock position built over decades. Under normal circumstances, selling that position would trigger a significant tax bill. But during this low-income window with expanded deductions in place, they can gradually unwind that position, diversify their portfolio, and reset their financial risk without handing a large portion of those gains to the government. This also matters for people delaying Social Security. Every year Social Security is postponed creates another year of controllable income. Those years are not empty. They are valuable. They are opportunities to convert assets, rebalance portfolios, and harvest gains at historically favorable tax rates. This strategy isn't about chasing perfection. It's about understanding that tax brackets are not static barriers. They are thresholds that can be managed, especially during retirement years when income is flexible. In the final section, we'll talk about why this opportunity is temporary, why the clock matters, and what retirees should be thinking about before this window begins to close. This opportunity is not about finding a trick in the tax code. It's about understanding how the system already works and recognizing a window that happens to be unusually favorable right now. The combination of low, controllable retirement income, expanded deductions for seniors, and the 0% long-term capital gains bracket creates a planning environment that doesn't come around often. But here's the critical part. This window is not permanent. Under the current law, the senior bonus deduction is scheduled to expire after 2028. That means the extra room it creates for tax-free capital gains has a clear end date. Once that provision sunsets, the math tightens again. The opportunity doesn't vanish entirely, but it becomes smaller and harder to use. That's why timing matters so much. Tax planning is rarely about a single year. It's about sequencing decisions across multiple years while the rules are still in your favor. For retirees, especially those delaying Social Security or sitting on large unrealized gains, the next few years may represent one of the most flexible planning periods they'll ever have. Now, an important disclaimer. Nothing in this video is personal tax or investment advice. Everyone's situation is different. Income sources, state taxes, portfolio structure, and future plans all matter. Before acting on any strategy like this, it's critical to review it with a qualified tax professional who understands your full picture. That said, awareness is the first step. So here's my question for you. If you're retired or approaching retirement, have you ever mapped out your taxable income year by year? Or have you mostly focused on account balances and withdrawal rates? And if you're not there yet, does knowing how powerful these low-income windows can be change how you think about retirement timing? Let me know in the comments. I read them, and they often shape what we cover next. If you found this breakdown helpful and want more clear, strategic explanations of how economic policy and tax rules quietly shape real-world wealth outcomes, make sure you subscribe to the channel. New opportunities rarely announce themselves loudly. That's what this channel is here to track. Thanks for watching. I'll see you in the next one.